Is Murabaha truly halal through asset transactions? Imagine buying a car or a piece of machinery without paying interest. Instead, you pay a fair price for an actual asset. That's what Murabaha aims to do. It's a common way Islamic banks help people finance assets while following Islamic rules. But is it always truly halal? Let's look into how it works and what makes it compliant or not. Murabaha is a sale contract where the seller reveals the original cost of an asset and adds a pre-agreed profit margin. The buyer then pays this total either immediately or over time. The key difference from a loan is that it's based on buying and selling a real item, not lending money with interest. This structure is designed to avoid riba, which is forbidden in Islam. For Murabaha to be considered halal, certain conditions must be met. First, the bank or seller must own the asset before selling it to the customer. This means they buy the asset first and take possession of it. This step shows the transaction is a genuine sale, not a disguised loan. During this period, the bank bears the risk of ownership, including any defects or issues with the asset. Second, the seller must clearly disclose the original cost and the profit margin added. Transparency is essential. The customer needs to know exactly how much the bank paid and how much profit they are making. This openness makes the deal different from interest-based lending, where the borrower does not see the interest rate. Third, there should be two separate contracts, one where the bank buys the asset from the supplier and another where it sells the asset to the customer. Both contracts must be real and not just formalities. This separation emphasizes the sale nature of the transaction. Fourth, the price paid by the customer is fixed at the start. It includes the original cost plus the profit margin. There is no interest charged on deferred payments. The customer agrees on the total amount upfront, making it a clear sale agreement. Fifth, if the customer delays payment, penalties may be charged. However, these penalties should not be a source of profit for the bank. Often, late fees are either donated to charity or waived unless the delay is intentional. This prevents the transaction from turning into a hidden interest charge. When these conditions are followed, Murabaha is generally seen as halal because it involves real assets and profit from a sale, not interest from a loan. It aligns with Islamic principles by avoiding riba and sharing risk through ownership of the asset. However, some scholars view Murabaha as a secondary or transitional method. They argue that in practice, some transactions resemble interest-based loans because the profit margin is sometimes benchmarked to interest rates. This can raise questions about whether it fully complies with Islamic rules. In real-world Islamic banking, Murabaha is widely used for trade finance, buying equipment or property. The bank purchases the asset requested by the customer and then resells it at a marked-up price. The customer pays in installments, making it a Shariah-compliant alternative to interest loans. To sum up, Murabaha can be truly halal if it involves genuine ownership transfer, clear disclosure of costs, and no interest or unlawful penalties. It is a sale-based contract that avoids riba by structuring the deal as a sale of assets rather than a loan. Still, Islamic finance guides often see it as a backup option, encouraging profit and loss sharing contracts as more aligned with Islamic economic principles.